Federal Reserve Chair Jerome Powell noted at the Economic Symposium in Jackson Hole 4 weeks ago that the path to reduce inflation would not be quick or easy. He acknowledged that the Fed may need to use the tools at their disposal forcefully to curb inflation, even at the expense of growth. Globally, other central banks have shown willingness to do the same, reinforcing that investors should remain cautious and expect continued near-term volatility. Let's take a closer look. Central banks try to dampen inflation by tightening financial conditions, including hiking interest rates. Last week, the Fed hiked rates 75 basis points and the Bank of England hiked 50 basis points, following up on a 75 basis point rate hike by the European Central Bank earlier this month. Since Jackson Hole, financial conditions indeed have tightened, as the U.S. two-year real yield, or the nominal yield less expected inflation, rose 130 basis points. Further, investment-grade spreads rose 10 basis points, and high-yield spreads rose 60 basis points. Other markets also weakened, including the S&P 500 index, which fell 9%, and most foreign currencies depreciated against the dollar. Just as the Fed supported these assets when they were trying to boost inflation, they now welcome the declines as they try to tame it. Central banks often espouse the existence of long and variable lags in the effects of monetary policy. Their jobs are even more complicated now because a number of factors fall outside of their control, such as the speed and magnitude of supply chain recovery, the duration of the war in Ukraine, and in the US, the willingness of people to re-enter the labor force. Moreover, governments worried about recession are passing legislation to encourage spending, arguably counterproductive to the inflation fight. The UK recently approved unprecedented spending and tax cuts equivalent to 3% of gross domestic product. Eurozone governments have passed aid totaling a more modest 1% of gross domestic product, primarily to alleviate energy costs. In the US, the immediate impact of the Inflation Reduction Act is less clear. Chair Powell indicated the Federal Open Market Committee would slow their fight against inflation when it has moved meaningfully back to their 2% target. According to the summary of projections released last week, this could be sometime in 2024. As a result of the uncertainty over the path of inflation and interest rates, we are underweight equities outside the US, including emerging markets. Further, given what we believe are upside risks to yields and a challenging near-term environment for credit, we are underweight investment-grade corporate bonds. We hold a modest overweight to high yield given the composition of the sector and relative valuations. But uncertainty has been the one constant theme in 2022, and we believe it will be with us through the year end.